Welcome to Subramani. I'm going to talk about a little bit of greed and fear, which are the worst things which can happen to anybody managing any portfolio. Even if you're an institutional investor, ultimately there is a man at the desk or at the laptop who is going to press the buy or a sell button. So whatever data he has, whatever he knows, what are the biases, whatever reports, that fear, greed, somewhere it steps in. Now imagine you were an investor in 2018-19 and you just started, and 2020 March happened and you had the worst headlines in the world. They said here is a pandemic. It has never happened in 100 years before. US people were dying, Europe people were dying. They were predicting that in India a few crores will die, and if not a few million, a few crores will die, or that kind of starkness which was being shown. And they had fantastic projections, terrible projections, however you want to look at it. In that scenario, you had to either stay calm or invest more, and the market from March 2020 would have doubled, right? So you take even the US every day headline was US hits a new high, the number of people dead was very high, and people are even commenting that it is good for us because we will get better social security because the numerator is going down. All such absolutely cruel comments were being made, and that time you had to stay calm, you had to invest more. It is definitely not easy. Navigating through 2020 and 2021, markets hit new high all over the world, and in 2022 January markets have been difficult. So being invested in the market and invest more in the market would have been not only difficult but extremely difficult, and few of us who have survived and who have perhaps invested more and made more money should be very happy, and we deserve a pat on the back. Remember, there was a time when the pandemic was being sold as the worst thing that could happen, and those people who invested in pharma and healthcare related services definitely benefited more. Here you were trying to make money out of one of the biggest miseries that the world was seeing in 100 years. It's not, it could have been very easy. So there would have been, you would have been hit by both fear that the world is going to end, or the greed that the healthcare companies would make money. How would you reconcile between the two? Were you investing or were you not investing? Go and sit and analyze what you were doing. It's going to be very useful, far more useful than worrying about risk, which is what we do. We worry more about risk and allocate less time to managing risk. That is the worst thing. So there will definitely be emotional upheaval during such investment times, and January 2022 has not been very different. If you take the US markets, there has been a lot of violence in the market, because one, you're expecting the Fed to change interest rates, increase interest rates. Inflation is really hitting US hard. There is no reason to believe that it is going to be very different in India. Just go and check your own inflation. If you have maintained records, you will know what is your own inflation. So actually, greed and fear act on us because of two things. One is we are not great analyzers of data. So we prefer coal over nuclear, in spite of the fact that enough data can be provided to show that nuclear is far superior to humanity as a whole. But unfortunately, when we think of one nuclear disaster, Chernobyl, or one in Japan, I don't remember, we don't know how many people died. We don't have enough data. We have enough data, but we don't analyze. But it is so scary that we would choose coal over nuclear, simply because in coal we do not see such big disasters happening, or there's a coal mining accident and people are killed. We don't identify ourselves with that. We don't think, oh, nothing is going to happen to me, I'm not a coal miner. Or the pollution caused by coal is just not visible. And I'm not saying therefore you should act very differently, that I'm not saying go short on Coal India. I'm just saying that be careful that our inability to analyze data. So therefore for us, plane crash is more scary than roads, though obviously more people get killed in road accidents than in plane crashes if you compare like to like data. But that is just more proof that greed and fear happens because of the impact that it has. So we think walking into the forest, we think the tiger has no business to attack us. Of course it has no business to attack us, but maybe the tiger thinks you have no business getting into the forest. So understanding risk is not something which we do very easily, and we normally go by whatever data is available. So we remember Chernobyl pictures if you were old enough, and we say, oh my god, I don't want nuclear power, and even if I have nuclear power, I want it far away from my house. I only want nuclear power. I don't want a nuclear plant anywhere near my house, maybe 150 kilometers or something like that. Or if a nuclear plant is coming up, maybe I'll shift away from that place. We are that scared about nuclear power because of the terrible pictures that we have seen. So similarly, when Times of India or New York Times or anybody carries headlines saying huge number of deaths and job losses soaring and economy is likely to be in a downturn, these were the kind of headlines which we were seeing in March 2020. That was the time when you had to invest. Now that means whenever you need bad news in the newspaper, that's a time to invest and not a time to panic. So risk management is more important, not just worrying about risk. Worrying about risk does not help at all, right? But our collective bias or an individual bias, that is what is hurting us, right? Similarly, can you imagine what it must have been like in 1929? Obviously, none of you watching this would have been born. 1987, when it did not have such a great impact on India, but yes, in US it was a big impact. Year 2000, when the dot-com bust. 2008, when there was this scam, the financial crisis, right? So these were times when markets fell and fell very quickly. That is what hurts people. When market falls over a long period of time, people get used to it, exactly like frog in the hot water, right? But like they say, Rome was not built in a day, but Nagasaki and Hiroshima happened in a few hours, right? So that is the problem. You build your portfolio slowly over a long period of time. You build 3 crores, 5 crores, 8 crores, 22 crores. You build here, right? Or you just make it 3 lakhs, 5 lakhs, 8 lakhs, 22 lakhs, whatever. And then one day that 22 lakhs becomes 14 lakhs or 13 lakhs because you made some mistake or something like that, or the whole market crashes. The whole market crash is easier to accept, but one single share of yours falling that much is something which will be more hurtful. But that is the time when you have to remain calm and be investing. That is the challenge. That's what I'm trying to tell you. All the big crashes in retrospect, I'm not saying in prospect, in retrospect are easy to predict. Or you can say that these were the numbers which makes you feel that the market is going to crash. Now, lot of that is prevalent today. Interest rates are likely to go up, and if interest rate goes up for very quickly and for a long period of time, markets are likely to come down. And when interest rates go up, obviously your bond market is going to be hit. So is it a good time to be investing in a long-term bond? The answer is maybe no, maybe yes. Is it good time to be investing in equity? Again, maybe no, maybe yes, because two things will happen. One, when interest rates go up, if there is slight slack in the economic activity, our great central bankers will go and stop increasing the rates, right? So one, you can't predict investment, the Fed behavior. When I say Fed, I include RBI. We just can't predict what they will do. Remember, 2024 is the election year in India. So in 2023 onwards, we may not see a petrol price hike, even if it happens outside, so which means your oil marketing companies could make losses. Now these are all the implications which are likely to happen, and I have no clue how we should be reacting to it. I mean, if you're in an index, you keep putting money knowing fully well that the index will go up. Whenever the index will go down, then index will go up. But since you have a 10-year, 20-year, 30-year view on the market, you can keep investing. However, if you're an equity investor shifting from industry, etc., it's a huge challenge. all the falls look predictable, so interest rate, so all these things you feel like the market is going to come down, but you could have exactly had the same feeling even in say September 2021. So in September 2021, if you had sold, you would have looked like an idiot in October, November, December, 3 months, but you would have looked like a genius in January if you were in FANG and other investments in US. But Indian markets have not really crashed or something like that has not really happened. January was a little the standard deviation must have been high, markets may have gone up, markets may have gone down. There was a lot of selling by the FIIs, but it was more or less countered by the Indian buying. So look at the SIP growth that is happening. It is amazing. We now have about 45 fund houses and so many schemes. So amidst all this, everything looks very optimistic in Indian conditions. You don't know how it is going to behave going forward. So with all these uncertainties, with the combination of high values, with fear of market crashing, with your bond portfolio looking at you and saying, look, interest rates are going to go up, why are you still holding me? And on the other side having information saying, oh, MSCI inclusion, if it happens, another 30-40 billion will come in. If that comes in, then what happens? What happens if the US Fed increases rates for 1 quarter or 2 quarters and then just stops? What happens if they are stunned into inaction simply because the market is not reacting to it or there is not enough growth happening in US? We have, with all these uncertainties, we have our fears and we have our greed. That is the problem. So we put too much emphasis on risk. We sit and talk about risk, but we do not put enough effort to manage the risk, right? That's the problem. So we get into the herd mentality of greed. We've got complacent saying that, oh, last 2009 to 2021, whether it is the US market or whether it is the Indian market, we have literally seen a singular bull run, and the corrections, even March 2020, were so swift that people were not hit too badly. So people who continued their SIPs have benefited, and they have now learnt a wrong lesson that if there is a fall in the market, you keep buying the dips simply because the market will recover. And our mutual fund industry, our educators, our insurance companies don't want to tell you that a fall can be there for a much longer period of time. So therefore your SIPs will be beneficial, but over a 5-year period, not over a 5-month period. That lesson has not gone through, and that can be very hurtful, right? So there is another problem which happens, that the media, I'm happily not including my channel, has a huge advantage of being optimist. Or even if I talk about that the market can fall, you should see the amount of hate mail that I get, because people don't want to hear that the market can fall. But the market can fall and will fall, because every bull run is followed by a bear market, right? So I've done enough videos on bear market, so I'm not talking about it. But remember that this party will also end badly. Every party ends badly, because there will be people with 10 pegs who are puking somewhere at the backside of the party, right? So this is bound to be happening. Just copying somebody else and saying, oh, he is optimistic, she is optimistic, the markets are optimistic. Every fund house comes and tells you that the SIP growth is happening and the SIP is the way to go, and that's how it should happen. I'm not getting into whether SIPs are good or bad, but SIPs are good long-term strategies to create wealth for you in the long run. Until then, the mutual fund industry is going to tell you that SIP is better than sliced bread. It is the greatest innovation, and there is no way how you can lose money with SIP. I want to tell you that you can lose money with SIP if the market stays low for 2 years or 3 years, and then what happens is after that you will make money. But the question is, do you have the ability and patience to stay low? Do you have the ability, and do you have a leverage position? Just too many people have a leverage position. So if you have a leverage position, it is very difficult to hold on to a leverage position for 3 years, right? So that is going to happen. And so when you see your neighbor getting rich, friend getting rich, brother-in-law getting rich, there is no way how you can stay away from the from FOMO. So that is another worry, and the government itself needs a lot of optimism because they want the LIC IPO to go through. Then they have a New India Assurance IPO or a privatization attempt, or rather a privatization attempt, maybe a couple of banks, and the government is going to do it very silently, and the government needs a bull market. Everybody loves a bull market because in the bull market everybody makes money. Broker makes money, the research analyst can keep on saying, like I can say, let's say Fortis Health is a good buy at 30, good buy at 130, good buy at 200, good buy at 260, good buy at 500. I can keep creating reports. What do I say what happens if I have to say, oh, this company is not good, it is going to go down? I can make only one report. I cannot keep on saying, oh, it's going to go down, it's going to go down. People have sold and there's nothing else to do. Whereas in a bull market, everybody makes money, so everybody is happy. Government makes a lot of SGT, so government is happy. Government needs to sell LIC and other stocks, so government wants to do that. Government gets capital gains. Now capital gains is very well captured, right? So with all this capturing happening, there is no reason why anybody wants a market to go down. But everybody expects, oh, something will happen to the market and the market will go down. So let me tell you what I did in 2007, 2008. I bought a nice book and I read that book and I went and sold a lot of my infrastructure stocks which had gone up. I mean, I can remember offhand I sold Tata Power at a PE of 100, BHEL, Kotak Bank, Cholamandalam, Larsen and Toubro. I remember a lot of these shares I had sold, and I was sitting on cash, which I could find it very useful in 2008 for me to buy. But that was I think partially luck, but also when you see numbers and you don't agree with that, then you should be able to sell. Unfortunately or fortunately, what would have happened in March 2020 is to say, oh God, let me sell the highly valued shares. So let me sell Google, Alphabet, or Facebook, or Amazon. These are very highly priced, so let me sell that. And that is exactly what went up. So now there are two things. One is to look at the data and say, oh my God, these shares are overvalued. There is no way how they can justify this PE. Other way to look at it is to say, yeah, but just looking at the past is not enough. For example, instead of buying an asset management company in India at some ridiculously high PE, you can invest in an asset management company in the US at perhaps half or 1/5 at least 1/3 the PE, right? And then so and money is fungible, so you can put your money there, or you can put money in a fund which invests in an AMC in the US. So the US markets are open today for you, right? Especially if you're using the LRS route or the ETF route. I don't know when it will get stopped, but so solely focusing only on past data is also not useful, because many Indians are investing abroad. So what I have tried to do in this is to tell you that there are too many data points, too many emotional points, all of it acting on you. I have no clue what you have to do, but I can tell you what I am planning to do. Since I don't require this money for next 10-12 years, I will continue to remain invested, and once in a while you will get opportunity like TCS buyback. So in a portfolio in your house, if you don't have TCS shares, you could buy it and give it for buyback, and whatever shares you have, anyway you can give for buyback. Partially it will get bought back and the remaining shares will remain with you, right? If I were a promoter, what I would do now at these current valuations, I would keep doing IPO, OFS, NFO, whatever you want to call it. I would try to raise money because people are very optimistic and giving money. People will be disappointed. I do not know whether the disappointment is going to happen in February 2022 or September 2022 or February 2023. I also know that by selling early, I can look very foolish in the short run, but I'm very happy to look foolish for 3 months and look very smart over a 1-year period. So I'm very happy. I'm selling, I'm also buying, so I'm reallocating, I'm doing all that kind of stuff. But you decide what you want to do, simply because there is too many data points telling you that the market is going to crash, and a lot of emotion which says, oh, the market is going to boom. Beware, the media has a vested interest in the bull run. It is for you to make your decision. Thank you.